Welcome back to my channel. It's Nasdaq with Ashia back with another video. Today we're going to be talking about, is the stock market going to crash? And before we begin, I want to say I'm not a financial advisor and you should always do your own due diligence and research before taking part in any investment scheme. This video is for entertainment purposes only. So let's get into it. Alright, so I have articles and I have a few charts. Oh, just one. Well, that's okay though. So, stock market crash is irrational unless we get disaster, said fund manager who called the bull rally. You can already tell that this is about stock market not crashing. And I'll tell you why, okay? So I'm just gonna pull up a chart, okay? Hang on. New share. There we are. So do you see this chart here? So there's something in the stock market called the triple top. So, and it's bullish for the for the Dow Jones to close over the triple top. And it's bullish for it to close over 35,092. This price here, I'm just rounding it to 92. And when you look at the chart of the Dow Jones, the blue line you see here is a 20-day EMA, and EMA is basically it's like a moving average. It's like an exponential moving average. So if we go back to our chart here, hang on, let me screen share again. So if we go back to our chart here, this red line here is the 50-day EMA. So pullbacks to those EMAs are healthy and perfectly normal. So the Dow Jones right now, as you can see here, is testing those EMAs. It's going up and down, just testing those. But it's supporting them, so we are A-okay for now. All right, so let's go back to the articles now, because I want to discuss the articles because that plays an important part. So let's go on to the main body of this article. So then David Barr, CEO of Zout Capital, I don't think I'm pronouncing that right, but I guess it's okay. There are very few fundamental challenges to the equity markets right now, says David Barr. He says that you have to have some level of confidence in the people who are responsible for managing monetary and fiscal policy. They've laid the groundwork, set the stage for what their prognosis is, how they're going to manage it. They talk about 2% inflation target, and all day, every day, people want to cut their legs off, from under their knees, and yet they're proven to be a stable and very thoughtful fiduciaries for the market. I just don't think that they're wrong. If they're that wrong, then we would have felt it by now, he said. So basically what he's saying is the environment is very stimulative and it's recovering already, and the monetary policy should not be a concern for investors. What's more is 13 of 18 policymakers unfortunately now see interest rates higher in 2023, with 7 of those penciling a rate liftoff as soon as next year. But this should be a surprise to nobody since our economy is like practically boosting like a rocket, like a NASA rocket. So it's basically recovering so fast, and it's like ahead schedule. So Fed officials opened debate on dialing down the 120 billion a month of bond purchases at the June 15-16 meeting, and since then most Fed policymakers have offered broadly bullish views of an economy that by many measures is sprinting out of a recession triggered by the global COVID-19 pandemic. So this shows that we are getting better. We have recent rate of job gains and above target inflation. So this should be a surprise to absolutely no one. And finally, Economic Outlook US Q3 2021. Here's the title. Ready? Sun, 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 here it comes. I'm already liking this. S&P Global Economics has slightly raised its real GDP growth forecast for 2021 and 2022 to 6.7 and 3.7% respectively, from 6.5% and 3.1% in its March report. The labor market still has a long way to go before it recovers the 22.4 million jobs lost from COVID-19, likely not before fourth quarter 2022. The unemployment rate will likely reach its pre-crisis range of under 4% by first quarter 2023. Although inflation has jumped on base effects and supply running behind reopening demand, we agree with the Federal Reserve that the price gains should be largely transitory. This is them, this is not me. We meaning people who wrote this article, assume the Fed's first rate hike will be in first quarter 2023, followed by another in the third quarter and two more in 2024. So, lovely people, in conclusion, we are A-okay for now, and our economy is ahead on schedule of recovering from the COVID pandemic, and we're doing just fine for now. So, thank you guys for watching this video. I hope you enjoyed this video. If you found this information helpful, please be sure to like, comment, and subscribe if you made it till the end. And if you're one of those lovely people, please be sure to comment Powder Puff and subscribe down below. See you in the next video.